welcome. You're watching Wealth Conversation. With equity markets roaring, we often hear about multi-bagger stocks, but rarely do we see multi-bagger mutual funds. Mind it, if you would have had invested 1 lakh in this fund 26 years back, it would have become 2 crores. Yes, you heard it right. 2 crores over 200 times growth. The fund I'm talking about is Nippon India Growth Fund, a consistent performer that has created immense wealth for its investors. To talk about the fund and its journey so far, joining me today is Mr. Manish Gunwani, CIO Equity Investments at Nippon India Mutual Fund. Welcome, Mr. Gunwani.
Hi.
Mr. Gunwani, if we talk about the fund, the Nippon India Growth Fund, it has shown consistent performance all through these years, growing at the rate of 22.62% CAGR. With wealth creation across market conditions, in last 3 years, the fund has registered a CAGR growth of 26.14%, and returns have been as high as 76% for 1 year. What has been your investment philosophy as far as this fund is concerned, and how challenging has the journey been so far?
Thanks. There are three or four elements of our investment philosophy. The first is that we are very, what I will call fair value focused. So when I mean fair value focused, what I mean to say is that we have a very big and experienced research team, and we cover a lot of stocks, and we have a fair value estimate of each of these stocks. Now, clearly, based on our research output, a lot of times we do get good opportunities across different kinds of stocks, right? Some could be value, some could be growth, some could be good companies going through a bad 2 or 3 years. So the first thing is we don't have any hang-ups about what kind of style or what sector or what size it is. So the good part about growth fund is also that you have a lot of flexibility across different market caps. So whether it is thematic, whether it is growth, whether it is value, whether it is a concept stock, we have an open mind about what we own in this fund. Even from a market cap perspective, there is a lot of flexibility. So the first philosophy is basically we are hunting for alpha wherever it is. The second is we typically tend to avoid companies with questionable long-term growth prospects, or what we call terminal value problem, which is typically when companies have technology disrupting their business model, or regulation, or long-term trends which are not in favor of the company's long-term growth. So while it's difficult to be accurate about it, but from a 5-10 year perspective, we think about whether this company can still grow or not. And we avoid companies where we have a doubt that from a 5-10 year perspective, their growth will be impacted by any of these issues, technology, regulation, whatever. Okay. The third is we tend to focus more on, because eventually it is a mid-cap dominated strategy. And we all think and want that our mid-caps become large cap. So we do tend to favor sectors which we think grow faster than nominal GDP. So let's say on a 5-10 year basis, again, we tend to cluster around 4 of these verticals: financials, consumer discretionary, healthcare, and technology/outsourcing. We typically feel that these large verticals, they are underpenetrated in a growing economy like India. And over the long term, a lot of value is created in such kind of sectors. Finally, we also spend a lot of time thinking and building a portfolio around some mega themes. Like today, we think, for example, the shift of manufacturing from China to India, which is called China Plus One trend, the proliferation of digital disruption, So when we have a fair representation in segments like IT services or internet platforms, because we think technology is getting more and more important in business models. Or there is a out of home consumption theme post COVID. So we think next 1 or 2 years will be very strong for out of home consumption. So we think about these themes and obviously try to find bottom up stocks which we feel that as a mix of business model valuation and management kind of match with these themes. So this is a kind of overall view of some of the important things about our investment philosophy.
If we talk about this fund, 26 long years, and through these years, we had 3 to 4 bull cycles and sharp corrections too. We had roaring 90s, followed by an era of tech boom. Then we had housing boom in 2004 to 2008. And then we had BJP coming into power in 2013 and 14, and the markets really rallied. And now we have the current good rally after March 2020. There has been no sharp correction, and the market is unidirectional, I mean, in one direction only. Take us through how did you manage through all these cycles, I mean, 26 long years, and how the portfolio constitution has changed with the changing scenario?
Right. So obviously this is a fund which has been there for many, many years. It has had different fund managers, but one important central tenet of this fund is that if you see as a house, we've always had a legacy of solid research, especially in the mid and small cap space. And this fund obviously has relied a lot on in-house research. And to a certain extent, a lot of the performance has benefited because of the in-house research and the way we have kind of institutionalized that research process. I can speak a bit in detail about last 3-4 years, how we kind of behaved through the waves, different waves that happened. So touchwood, we've got most of the big changes in the last 3-4 years. So for example, in 2018 January, which was kind of the peak of global reflation boom and the peak of emerging market boom. I remember that when the PNB banking scam broke out in Feb, we had a portfolio which was quite cyclical, which was also very high on mid and small caps. And that time, this fund also went through the SEBI categorization exercise. So that time, the small caps were higher than what was mandated by SEBI. So what we did was both from a macro perspective of the global reflation boom ending because of US-China trade war picking up, and the domestic economy facing challenges because the banking and NBFC sector seem to be tottering a bit. Over April, May 2018, we were able to reduce our small cap and mid cap exposure, reduce our cyclical exposure quite a lot. And that helped us over the next 12 to 15 months because unfortunately for India, between the US-China trade war globally and the NBFC crisis, which kind of accelerated with ILFS in 2018 September, the economy obviously had fair amount of challenges. So we were more in the pharma and FMCG kind of defensive sectors. And therefore, the fund did reasonably well, absolute terms, quite well actually in terms of relative to other funds. 2019 calendar year, last quarter is when we started becoming more positive on the global economy and even the domestic economy, because after that phase of US China trade war, slowly things started getting back to normal. If you see both domestic and global economic data, it started turning around in a positive manner. And we started adding a bit of cyclical exposure because a lot of the cyclicals had got hammered over the last 2 years, in the sense 2018 and 2019. Um, Now, unfortunately for us, when COVID came out of the blue, which was 2020 Feb end, this part of whatever little cyclical exposure we added hurt us a bit. And we also were a bit unlucky. I feel that almost by coincidence, we had a lot of outdoor consumption stocks, whether it's multiplexes or beverages. Now, till that point, all these were seen as quality consumer franchises trading at high price to earning multiples. And no one had forecasted that based on outdoor, there would be some issue, right? Because no one had really thought of a pandemic coming. So our performance kind of dipped a bit in March 2020. But post that, I think typically there is a playbook about how economy recovers from recession. And there is a playbook about how that is manifested and how which sectors are perform in the stock markets. And we have, I think, been reasonably efficient in playing the entire rise from a global recession to today. I think the market is probably late stage. Economy is still mid stage, but market obviously has priced in a lot. But so if you see the successive 2 or 3 different points since April 2020, I think they were the first phase was just a defensive value sector like pharma doing well and hospitals doing well. So post-COVID, we had almost 20% exposure to the healthcare vertical. And then as pharma became expensive, and at the same time, there was some green shoots about the COVID going away. We had a reasonable exposure to what I would say the clean cyclicals. So the clean cyclicals are IT services where the balance sheets are very good, cash flows are very good, or the retail banks where there is a strong track record of asset quality. This was from, let's say, June to November of 2020. And from November, when we saw that the vaccination news was turning positive, we had we increased the cyclicality of the portfolio, which again helped us do well from November to, let's say, when the second wave came. Second wave, we got hit a bit again on outdoor consumption stocks, but we also booked profit in a lot of the cyclical names which went up from November to March. And therefore, in fact, we added to outdoor consumption stocks in that correction which happened in the second wave. And today, a lot of those stocks have done very well from the March to May prices. Across this recovery, we've been fairly heavy on internet platforms and tech kind of plays. So it's not only direct IT services and tech platforms, but even in sectors like banking and healthcare, we've held the companies which are more well known for managing the technology better. And I think what we're finding is that typically those stocks are outperforming within their own sectors. So overall, I think since that hit which we got in March 2020, we have generally hopped across sectors quite well till now, touch wood.
Mhm. Yeah, the fund has really done well in last 1 year, 76%, more than 76% returns now. Very curious to know if there are some stocks that you have been holding in the fund since inception.
Yeah, so this fund, as I said, went through the SEBI categorization, so it has changed character a bit. So more than this fund, for example, I think DVs is a stock which we've been holding since maybe mid 90s. So there are stocks like that where we have held on for almost 20 years, I would think. Um, it might have been in this fund, some other funds, I don't know exactly. But yeah, those are journeys which are very pleasant to remember actually, because you basically ridden a company from small cap to large cap in a sense.
Talking about this fund again, you basically invest in mid-sized companies. So while you can expect higher returns in the long term, there will be more severe ups and downs if we take into medium to short term. Tell us something about the risk management tools that you adopt to tie over the difficult situations.
So risk management is very central to our thinking. So across the house, we have a concept of fund casing, which tries to, you know, give borders to the fund about what it can or cannot do. And this is very, very central to our journey of institutionalizing our research process and fund management process. So there are two, three things about growth fund in specific I can talk about, which are part of the fund casing just as a risk management uh, tool. One is that while the mid cap index tends to be more fragmented than the large cap index, and we are not very benchmark aware, but if you see our active share, which is how much is our fund different from the benchmark. So active share is basically about, let's say, if you don't have any stock in the benchmark, you'll be 100%. If you're perfectly like the benchmark, you'll be 0% active share, and everything else is in between. So we have a mandate that we will not cross 70% active share against the mid cap index.
Okay.
The second is within our house, we cover a lot of stocks. And what we do is we bucketed all the stocks into four buckets of risk, which is purely based on business and management. There's no valuation risk in that. So based on a few parameters of business and a few parameters of management, we classify all stocks into four different risk levels. And then we say that if the benchmark has certain risk level based on this kind of risk methodology, the fund can have only this kind of risk. It will be more than the benchmark, but it will not allow you to take extraordinarily high risk. So we put boundaries about the risk that is there in portfolio from this fundamental perspective. So in growth as well, there is a risk on how much we can have of these lower quality rated stocks. And we obviously adhere to that. So that is another way of risk management. Thirdly, at a sector level, again, because mid-cap index is very fragmented, it's difficult to be very precise in sectors, but we generally ensure that in large sectors like financials or consumers, we are not very, very different from the benchmark. So we don't like to run very high beta fund or very low beta fund. I think both are risks in themselves. So we ensure that we are not taking a very big macro bet with this fund. So in these ways, we ensure that there is a robust risk management around the fund.
What are the top three sectors that have maximum weightage in the fund holding as of now, and why?
So with mid-cap, as I said, the sectors are very fragmented. So maybe I'll prefer to say the top three themes rather than sectors, because these themes play across very small segments. So today, and this, I think we've been fairly consistent across last 2-3 years. The first theme we have is this proliferation of technology. So which we played through either, so IT services, we are overweight. Internet platforms, we are overweight. And as I said earlier, that there are stocks within banking, healthcare, where if the management has demonstrated that they can use technology as a differentiating factor in their business model, we have a fair amount of weightage to those stocks. So the first theme is basically this whole digital disruption theme, both direct and indirect plays on that theme. The second theme is China plus one. Chemicals is probably the most well-known example of that theme which we have. But we all also have electronic manufacturing and textiles, which we think is a part of that theme now. So that is the second. And third is out of home consumption, which is across sectors like retailing, beverages, multiplexes, ticketing platforms. Across 5, 6 sectors, we have stocks based on the theme that post 15 months of COVID, I think the top 10-15% households in India have a very robust balance sheet. And I think with marriages, temple tourism, and a lot of other reasons, people will travel and spend a lot over the next 6 to 12 months. So I think these stocks which were impacted the most by COVID, they will, and they have come back a bit, but I think relatively there is still some more steam in that theme.
So can we expect the fund to continue yielding aggressive returns going forward, or one needs to tame down on the expectations as the markets stand at all-time high?
So we've been quite clear that while there is a very, very rich legacy to this fund, but honestly, going forward, the way we think about returns is that if we are able to deliver anywhere between 4 to 6% above the mid-cap index, that we will be quite happy with that. And I think that will generate absolute returns, although market direction is always very difficult. So that's the first point, that we are looking at it more in terms of beating the mid-cap index by 4 to 6%, maybe more, but that is the base effort we want to put in. The second is now clearly from a more near-term perspective, I think investors should be disciplined about asset allocation. This is not the time to raise equity allocation too much, because after a period of stellar returns, there's always the temptation to load up on the asset. Yeah. But I think all of us need to be responsible enough to say that returns can be healthy, but we should not expect what has happened in the last 15 to 18 months. Anywhere close to that, you will not make those kind of returns going forward, is our guess, because clearly when you are buying stocks, when globally economy is bombed out, when there is a big recession, that is when you make the most amount of money. Now, clearly we are, as I said, I think the global economy and domestic economy are probably in mid-cycle, but the market is a bit ahead and has discounted and is probably in late cycle. So I think that we should be more realistic about returns over the next 1 to 2 years. But in the long term, I think equities, as we have seen, between returns, liquidity, convenience, they're probably much ahead of most of the asset classes. And I think that's why people should be disciplined and have their core allocation to equity as always.
One last question, Mr. Gunwani. Where do you expect the markets to move from here? I mean, at record high?
So I think what is, okay, so quickly 2 or 3 points, positives and negatives, is one is obviously valuations are expensive, but there is a corporate earnings cycle where for 7-8 years, the corporate profits to GDP have been suffering, and now last 12 to 15 months, that has turned around. And I think the second important part is interest rates, both nominal and real. Now, nominal is basically what you see actually, which is that home loan rates are 7%. A lot of good corporates are borrowing money at 5 to 6%, which is obviously very low. Also, in real terms, interest rates globally are deep into negative territory, and because the developed countries like US, UK, Europe, Japan, they're running the highest negative real rates ever. And that obviously favors equities because inflation helps top line growth, gives you operating leverage. Whereas for bonds, it is a bad time because with so much inflation, if you're not getting decent yields, then investing in bonds is less attractive. So low real rates typically lead to funds moving from fixed income to equities. So that is the second big trend globally, which is helping equities, I think. Net, I think that if this corporate earning cycle, which is looking more and more clearer day by day, manifests itself through 2 3 years of good compounding, maybe anywhere between 18 20 25%, then we can live with these high price to earning multiple, but the returns will still be lower than earning growth. So I think as a conservative investor, I should assume that price to earning multiples should fall as earning growth normalizes, which is why I feel that the market returns would probably be less than earning growth, but earning growth will be high enough so that we should still get reasonably okay market returns. But I think it's important for investors to be a bit more diligent today versus 12 months back, bit more disciplined about sticking to where their long-term allocation to equities is.
Thank you, Mr. Gunwani, for your time. It was a pleasure speaking with you.
Thank you.
Thank you so much.